Okay, so now we're going to be talking about financing for commercial real estate. A lot of the concepts and terminology overlap, but I think it's worthwhile to just go through the important terms that you're going to see in the world of commercial mortgages so that you're familiar with them. And when you hear these terms discussed by uh, you know, when we watch videos on, you know, uh, how to invest in a commercial property, you're going to hear these terms. So it's worthwhile to spend a little time and make sure you're familiar with them and know what they mean. Okay, so the first one is recourses versus non-recourse debt. Okay, so what recourse refers to is recourse to kind of the person who's making the investment. Okay, so usually the way it works is that when a person, even an individual, wants to buy a commercial property, and especially a larger commercial property, they're going to create some legal entity and that legal entity is going to own the property. Okay, so there's some separation between the individual as a person and the owner of the actual property, which is going to be some legal entity, an LLC or some kind of, an LP structure. There's different legal entities that exist that separate the individual from the ownership of the property. And the reason why this is that the individual, if things go badly with the property, they want to not be personally liable for, let's say there's some lawsuit, the if it's a residential property, one of the tenants falls down and sues the owner of uh, the property. They're not going to be suing the individual who owns it. They're going to be suing that legal entity. So um, there's some separation. Now, lenders don't necessarily like this because they want the person or the group of people who own the property to really have skin in the game. So some loans will be recourse, meaning that they'll require the individuals to put up their own personal assets because you may own one apartment building and have that as a separate kind of like set up a legal entity that just owns that one building, but you as an individual are going to own other property, you're going to have stock, you're going to have other investments. And so your net worth is not just represented by that one property. So what the bank is basically saying is, hey, we'll make the loan against that property that you want to buy, but you're going to have to put up all your other assets in case something goes wrong with that particular one investment. So that's what a recourse kind of financing is going to ask for. It's going to ask for a personal guarantee where the individual who's buying the property or someone in the group who's buying the property is going to pledge their personal assets to kind of guarantee the loan. There are options that are non-recourse. So the bank may be like, okay, you don't want to put your personal stuff at risk. Typically, they're just going to charge more interest for that because it's more risky to do that. If you are pledging all your personal assets, you can say the risk for the loan is lower because, you're going to make sure that that loan doesn't go bad by kind of backstopping it essentially. So the bank likes that, and so they'll charge you less interest if it's a recourse kind of financing. Um, a non-recourse is available again, but the interest rate is typically going to be higher. During periods of time where lending is very restricted, during recessions, when the banking industry is under stress, they may get rid of non-recourse debt, and you'll have to put up a personal guarantee to get the financing. So, the availability of these is going to depend on kind of market conditions. Okay, prepayment penalty. So when a bank or a lender is going to give you a loan for, let's say, 7 years, they want to earn interest for all 7 years because if you pay that loan back after 1 year, they're going to lose out on that kind of income that they've planned for those remaining 6 years. And so, why would a borrower pay back that 7 year loan early? It's probably because, let's say, in year one, the interest rate that you take the loan at was, let's say, 7%. Now, if it's a 7 year loan, the lender is expecting to collect 7% interest on whatever they lent out for 7 years. But let's say the third year of the loan, in year three, the market interest rate has dropped to, let's say, 4%. Okay. You as a borrower, like, hey, right now I'm paying 7% on my mortgage that I took out a couple years ago. I can get a new loan and only pay 4%. Okay. So, you as a borrower, it's a no-brainer. You can basically pay much less interest by taking out a new loan. The lender who lent you this money in year one isn't going to like that, because if you pay them off, they're going to have to reinvest that money, and they're now only going to be able to earn 4% because now the interest rate environment has changed. So they were earning 7%. Now they're going to get their money back if you refinance and only make 4%. So they don't like that. So the way that the lenders disincentivize borrowers from doing that, being opportunistic in refinancing, is having prepayment penalties built in to the loan. So in this first year, when you agree to the loan, you're also going to agree likely to some prepayment penalty structure. Okay, so the bank is going to basically say, if you pay me back early, you're going to have to pay some fee for doing that. Just to be clear here, in year three, instead of the interest rate being 4%, let's say it went up to 9%. Clearly, you as a borrower are not going to refinance because you're getting a good deal. A new loan would cost you 9%, but your current loan is 7%. So there's no risk of prepayment, in the normal course of business. Of course, if you sold the property, the bank is going to likely get paid off. But you as the owner have no incentive to refinance because the interest rates are higher. Okay, so it's only in this case where interest rates go down that this risk of prepayment happens typically. So again, the bank is going to impose some kind of prepayment penalty to prevent that. So there's a couple of different options that are ways that the lender will structure this prepayment penalty. One is yield maintenance. So this is a more complicated kind of um, calculation. I'm not going to go too much into the depth of how yield maintenance is calculated, but basically there's like the lender is expecting some kind of compounded rate of return, and the yield maintenance will, depending on when you pay the loan off early, it's going to change the calculation and kind of give that rate of return to the lender. So it's going to do a present value calculation on the remaining kind of interest they would have earned. And, it's a little more of a complicated calculation. A step down is a little more straightforward, where they're like, if you pay me off, if I gave you the loan in 2020, if you pay me off in 21, you have to pay a 3% penalty, meaning if you borrowed $100, if you pay me off early, you have to pay me the $100 plus an additional 3%. So an extra $3 plus the interest that you owe me. So it's a upfront kind of fee. You have to pay just 3% of the principal. And then if you pay me off in the second year, it steps down to 2% and then 1%. So 3, 2, 1. So that if it's a 7-year loan, if you pay off the loan within the first 3 years, you're going to pay some penalty. And then after that, it's stepped down. So you could just pay it off without a penalty. But for those first 3 years, they're kind of protected a little bit by having the step down prepayment penalty. Okay, interest only loans. So these are loans where uh, you are only paying interest on a regular basis. Okay, so typically, like when you get a mortgage as just a regular individual buying a house, a 30-year mortgage, those are fully amortized, meaning that monthly payment that you're making on your mortgage, some of it is interest and some of it is principal, meaning it's going towards the actual loan balance. So at the end of 30 years, you will have basically zero owed to the bank, because over those 30 years, you are not only paying the interest, you are also paying down the loan a little bit each payment. An interest only loan has no portion of the payment that is principal, and you're only paying the interest. So that has the benefit of keeping your payment lower, because if you're including some principal, your payment is just going to be higher. So if it's interest only, the loan payment on the regular basis is going to be as low as it could possibly be because you're not adding any additional amount for principal. The downside, of course, is at the end of the loan term, the balance. So if you borrowed $100,000 um, at the end of, whatever, let's say it was a 5-year loan, at the end of the 5 years, you're still going to owe that 100,000. You'll have not reduced that balance at all that you kind of owe. And so you have to figure out a way to either pay off that entire amount or find a new lender that will lend you another 100,000 so that you can pay off that existing loan. So it's a little risky if you don't have the means of kind of refinancing. And so we're gonna kind of see a case study in this module of General Growth Partners who kind of ran into that situation where they had to refinance a bunch of loans that were coming due and they were not able to, and kind of ran into a lot of problems because of that. So interest only loans will exacerbate that problem because you'll owe a lot more than you would have. Even if you had a partially amortizing loan, at the end of the term of that loan, you'll have at least a smaller amount that you have to pay off instead of the full amount that you initially borrowed. You'll hear this term rehab. It's short for rehabilitation. So this is basically what a you hear about people that flip property. So they'll take a really rundown property, they'll invest money, time and effort to kind of fix it up. So they'll hire people to kind of, redo the kitchen, change the floors, paint the place, maybe paint the outside, redo the landscaping. This all falls into the kind of topic of rehab. Okay, you're rehabilitating a property. You're investing not only the cost to buy it, but an additional amount to fix it up and make it and improve it essentially. Some properties don't need rehab because they're already kind of redone. Someone has already done that work, and you're buying the property already kind of in a condition that doesn't require uh, significant rehab. But some investors like to buy properties that do need it because they will sell for less money. So your cost basis, the amount that you're kind of putting in to buy the deal is going to be lower, and then you will get some benefit for that time, effort, and capital you invest to make the property nicer. There's going to be some extra kind of value that you're going to get for that beyond just what you spent. And so a lot of investors like that because they can kind of create value by investing that effort to rehab a property. Okay, loan term refers to the length of the loan. So you can have, a 3-year loan, a 5-year loan, a 10-year loan. All those different lengths refer to the loan term. Okay, extension options. So later in this module, we're going to talk about bridge financing, which are typically shorter term loans. What an extension option is basically, let's say you had a 3-year bridge loan. Within that initial agreement, when you first take out the loan, there may be extension options built in, which basically state, let's say at the end of the 3rd year, you're like, hey, I actually need a little more time. The lender will agree to extend the loan. Let's say you have uh, 2 1-year extension options in that loan. Okay, so what that means is that at the end of the 3rd year, if it's a 3-year loan, they're giving you basically two different options to keep the loan extended. So the first one, you can say, hey, I need 1 more year. Okay, so you'll within the loan agreement, it'll say, okay, you have to pay me maybe 1.5%, and I'll extend the loan for another year. Okay, so then that 3-year loan is now a 4-year loan. So the lender is going to agree to give you 1 more year. You're going to pay for it, but you'll get that year, and you don't have to figure out a way to kind of pay off the loan yet. And then let's say at the end of the 4th year, you're like, okay, I need 1 more year. So then you will avail yourself of that second 1-year option. Okay, so then you'll pay another whatever it is, 1.5% of the kind of outstanding principal balance, and that will give you another year. Okay, and then at the end of that year, you'll have to do something because you only had two 1-year options and you've kind of used them up. So uh, if you can, the best option is at the end of the 3rd year, just figure out a way to refinance into kind of maybe a longer term loan, and you'll avoid paying those extension option fees. But if you needed the more time, the extension options are kind of a bailout where you can kind of get a little bit of more breathing room if you needed, if your project needed a little more time, etc. You have those options to extend. Amortization, this refers to the schedule of paying off the principal balance. Okay, so we talked about interest-only loans. Amortization has to do with paying off the principal. So there are different amortization schedules. So we're all kind of maybe familiar with the 30-year mortgage for buying a house. Those are fully amortizing over 30 years, meaning that the amortization is such that at the end of the 30 years on that last monthly payment, you'll have paid off uh, the last remaining principal. A lot of commercial mortgages are shorter than 30 years. And so let's say you had a 7-year loan. To pay off all the principal in 7 years, the payment is going to be really massive. Okay, so typically what they do is they'll be like, okay, the loan is 7 years, but we'll put the loan on a 30-year amortization, meaning that uh, the principal payments will act as if you have 30 years to pay it off, and so the payment will be smaller because let's say you had just a very simple example. Let's say you had $100 that you borrowed. If you had to pay it off over 7 years, the principal, it'd be 100 divided by 7, which is around 14. If you had a 30-year amortization schedule, you would have 100 divided by 30, which is approximately 3.3. So you can see here, sorry, it's not the best handwriting, but I think you get the idea. Uh, a 30-year amortization schedule is just going to make the payments much smaller. Okay, so um, though the loan will be due in 7 years, the principal portion during those 7 years is going to be assuming a 30-year loan. And so at the end of the 7 years, there's going to be some principal balance. Okay, you're going to have to refinance the loan, but you'll have paid down some of the principal balance. Okay, so you won't have to refinance as much as you would have if you had no amortization. Okay, so the next term is occupancy. So this just refers to basically how much of your commercial property is kind of occupied by tenants. Okay, so there's a little nuance to this. So there's physical occupancy and there's economic occupancy. So physical occupancy refers to what percentage of the kind of rentable space is actually occupied by a tenant, physically occupied. And so, for example, in an apartment building, if you have 10 units and nine of them have actual human beings in them, you're going to have a 90% physical occupancy. If you're an office building and you have, let's say, 10,000 square feet of space and 8,000 of that is actually occupied by a tenant physically there, present, then it's 80% occupied. Physical occupancy is 80%. Economic occupancy refers to, of those kind of total space, how much are you actually collecting in rent? Because you could have a tenant who's occupying one of your units but is not paying you rent, right? They're maybe delinquent, they've lost their job, they're not paying you. So even though you have a physical occupancy of whatever X, the economic occupancy is going to be lower because some of those tenants are not paying you. Now, you could have an economic occupancy that exceeds your physical occupancy in certain kind of special cases where, for example, if you rented out a unit to someone and they haven't moved in yet, so the unit is technically physically vacant, but they're still paying you rent, or maybe they moved out early, so they are continuing to pay the rent, but they're just not physically there. You could have an economic occupancy that's greater than the physical, but in most cases, the economic occupancy is going to be equal to or less than the physical occupancy. That's kind of the more normal case. But differentiating those two is important because let's say you're buying a apartment building that's kind of in not the greatest area. Um, Maybe it's like class C. You know, there's different classes of property. A class A would be like in a really nice, centrally located, high-end area. and it's a nice property. A Class C property is like kind of sketchy. You may have a high physical occupancy, but maybe many of those tenants are not paying rent. You have to do a bunch of evictions. So you want to know the difference between the physical and the economic occupancy. Okay, fixed versus floating rate interest. So fixed rate is when you're paying the same amount of interest that's kind of pre-negotiated upfront when you take out the loan. While floating rate is you're basically saying, hey, interest rates are changing all the time. Um, I'm gonna basically take a little risk and just go with the flow of what happens with interest rates. If they drop, it's gonna be to my advantage. If they go up, I'm gonna get a little burned, but I'm willing to take the risk. And so the trade-off is, let's say the prevailing short-term interest rate is 2%. To get a fixed rate loan, maybe the lender's like, okay, you're gonna have to pay 3.5% fixed. I'll give you a fixed rate, but it's going to obviously be higher than the current prevailing floating rate because I'm taking away a lot of the risk. Okay. So you're going to have to pay up for that. Now, if you get a floating rate loan, you start off paying this 2%, but then if the rates go to 4%, then you're kind of you're going to be unhappy because you could have locked your rate in at 3.5. But of course, if it drops to 1.5, then you're happy. And if it stays at 2, you're happy also. So you're taking a little more risk with the floating rate, but there could be a benefit if you get kind of lucky if with interest rates moving in your favor. So the way it works typically is that the floating rate is going to be benchmarked to some interest rate. Okay, so the most common one now for commercial loans is this SOFR rate. So SOFR is essentially you can consider risk free because it's the rate. It's basically if you were a bank getting a loan from the Fed, and the collateral is U.S. Treasuries. Uh, what interest rate is the Fed going to charge you? Okay, so it's a short-term loan, and your collateral is basically risk-free, which is U.S. Treasuries, and so it's essentially the risk-free rate. What is just the minimum interest rate that is existing in the market, and then what the loan is going to do is give you a spread off of that. Okay, so this is like maybe this is the min. Okay, this is the best interest rate anyone can get, the lowest interest rate that a large bank can get just for borrowing for one day, essentially. So you are obviously going to be more risky because you are not the U.S. government, and you're going to be taking out the loan for a longer period of time. So you're not going to be able to borrow at this SOFR rate because you're more risky. This is the kind of the risk-free rate. So what the loan will do is basically be like, hey, your floating rate is SOFR plus some spread. Okay, this is called the spread. Okay, so SOFR is going to change. Okay, this is going to change as per the Fed's policies, supply and demand, what's happening in the economy. SOFR is going to go up and down, but your spread is going to stay the same. This is a fixed spread off of what is happening in the prevailing interest rate environment. Okay, so um, this is how commercial loans are essentially quoted. You're going to have some benchmark. This is called the benchmark interest rate, and then you're going to have the spread on top of that, and that's kind of compensating the lender for taking extra risk on you. Okay, so this spread is going to change based on market forces too. In in environments where it's very hard to get a loan, the spread is going to be higher. When the lenders are really competing for business and there's a lot of money sloshing around, the spread will decrease. And then this benchmark rate is also going to increase and decrease. So that's why if you take out a floating rate loan, not only are you going to care about this SOFR rate, the benchmark, because that's going to alter your interest that you're going to pay on the loan. What the spread is off of that is also going to be relevant to you. Okay, an interest rate swap. Okay, so many loans that are offered in kind of commercial lending are going to be floating rate, but you as a borrower, if you're not explicitly offered a fixed rate from the bank, can fix your rate through entering into what's called an interest rate swap. So let me just quickly draw a diagram of what happens when you enter into a swap. So this is you, the borrower, okay? You are getting a floating rate loan from the bank. This is the bank here. And so you're going to be paying them a floating rate. Okay, but you don't want to do that. You actually want to fix your rate. Okay, so what you can do is you can enter into an interest rate swap with this third party. So this is going to be your swap counterparty. Okay, swap counterparty. So what you will do is essentially say, hey, uh, me and you are going to basically decide that I will pay you. Let's say the prevailing interest rate is 2%. You're paying 2% here, and then but this is going to change. This could go up to 4. This could go down to 1. So this is going to float, but right now it's 2%. You, as the person who's interested in entering the swap, are like, hey, I will pay you 3.5% fixed, and you will pay me the floating rate. Okay, so when you first enter into this swap, this person is happy because right now they're only going to pay you 2%. Okay, and then you can basically pass this through to the bank. Okay, so now let's say the interest rate went up to 5%, and this person's happy. They're getting 3.5 from you, and they're only paying you 2, so they're getting a 1.5% spread. Okay, so they're happy right now when you first entered the swap. But let's say the interest rates change to 5%. Okay, so you are still paying this party 3.5% because that was what you agreed to when you first entered it into this swap. But now they're paying you 5%. Okay. And you're able to pass that 5% to the bank. Okay. Because you're getting it from this counterparty. So the bank is, from their perspective, getting a floating rate because they were getting 2% here. Now they're getting 5%. You, as the borrower, are have always been just paying this 3.5%. And this swap counterparty took that risk for you. They took this floating rate risk for you. Okay, so they were benefiting when the interest rates were lower, and now they're suffering when interest rates are higher. Now, of course, if the interest rates went down, they're going to make even more. Okay, so this swap counterparty is basically taking a risk on the interest rate. Okay, and this difference initially is going to be determined by how much volatility or how risky the rates are. Okay, so if rates are expected to go up, even if the rates, let's say, were 2, but the market was like, hey, we're expecting rates are going to go up because this 2% is unsustainable. Maybe initially when you make the swap, if you really want to fix your rate, you might have to spend 5%. Okay. It may be you're gonna have to come in and instead of paying 3.5, you're gonna have to fix your rate at 5. Okay. So this swap market is also determined on what expectations are. So it's going to be more expensive to fix your rate if the market is thinking that rates are going to go up because no swap counterparty is going to be like wanting to take that risk because they're like the rates are going to go up. I need to be compensated even more because I expect the rates to go up anyway. So if you're going to want to fix your rate, you're going to have to pay me more. So this swap market is also a market. It's going to be determined by expectations and supply and demand, etc. Now, one thing I will mention is that the bank does not really care about what's going on with your swap counterparty. So if your counterparty just dies or goes out of business, the bank is going to want basically its floating rate. So the riskiness of your swap counterparty is also relevant because if you took out a 7-year loan from the bank, you're going to enter into a 7-year swap with the swap counterparty to match that. Now, in the second year, if the swap counterparty is bankrupt and they stop paying you this floating rate, then you are going to be on the hook for it. Okay, so this is why during the 2008 financial crisis, the investment banks were considered kind of money good counterparties. whoever had entered into swaps, because a lot of the swap counterparties, either the bank is gonna be the counterparty or they're gonna facilitate. They're gonna be the middleman. So they'll stand between you and some other investor who's the ultimate kind of counterparty to you, but they're gonna be kind of the middle person. So if the investment banks went out of business, then this whole swap market, which is a massive market, would have been in massive turmoil. So, so yeah, you as the borrower are just making an agreement with the bank, and then you're entering into a separate agreement with your counterparty, and the bank is not gonna really care if something happens at counterparty and they're not able to fulfill their obligation. You're still gonna be on the hook. So this is why it was such a massive kind of uh, entanglement of the financial sector during the 2008 financial crisis. Okay, net operating income, I'm not going to dwell on for too long because I'm going to do a separate video on how to calculate that. But it's essentially the income that is generated by your commercial property without considering uh, any any factors of how you finance the deal. So it's just the operating profit. Okay, it's just seeing how much you're collecting in rent and other income minus all the expenses you would have paid even if you had bought the property all cash. You didn't have any loan on it. Okay, so you'd still have to pay insurance, maintenance, property tax, all those expenses that you would have had to pay no matter how you financed the purchase. You're going to see what that operating income is. Okay, so I'm going to do a separate video on how to calculate that because NOI, as it's called, is a very important metric in commercial real estate. So I think I'll spend a little extra time showing you how to calculate that. And then pro forma versus actuals. So a pro forma is essentially a kind of hypothetical. It's based on assumptions that aren't actually true. Okay, so maybe you're gonna buy a property and you're like, hey, I'm gonna rehab it, and then the rents are gonna go up, and you're gonna make a financial statement, basically a profit and loss statement, assuming the new rents that you are gonna get after you do the rehab. The actuals are just what actually in its current state the property is generating. Okay, so pro forma is typically going to be a forward projection. Okay, it's like a future hypothetical what's going to happen kind of thing. The actuals are what has actually happened, so it's more of a looking back kind of thing. So you're going to see this kind of notation T12, T3. What that means is trailing 12. Okay, so what that means is the T12 actuals is basically give me the last 1 year of actual profit and loss. Okay, so when someone asks for the T12 actual profit and loss statement, it's asking for the last one full year. Some people may ask for the T3, meaning just the last 3 months, which is much more current. It's maybe not going to be averaged out over these other months that are more further away. But typically T12 is like the standard that you want to get to really understand what's been happening with a property on an actual basis.